Federal Reserve Chair Powell signals rising employment risks, what it means for markets and policy. Federal Reserve Chair Jerome Powell's recent remarks at the National Association for Business Economics in Philadelphia have sent ripples through financial markets as investors parse his cautious tone on employment risks and the potential for further rate cuts. Powell noted that while the broader economic outlook for inflation and employment hasn't shifted dramatically since the Fed's September meeting, the downside risks to employment appear to have risen. This subtle yet significant shift in rhetoric suggests the Fed is growing increasingly concerned about a softening labor market, even as it continues to wrestle with inflation pressures. With the Fed's next policy meeting on October 28 to 29 looming, let's unpack the implications of Powell's comments, set them against historical context, and explore what this means for investors and the global economy. A delicate balancing act, employment versus inflation. The Federal Reserve has been walking a tightrope for the past few years, aiming to tame inflation, spurred by post-pandemic supply chain disruptions and geopolitical tensions, without triggering a recession. Since 2022, the Fed has aggressively hiked interest rates to a 23-year high of 5.25 to 5.5%, a stark contrast to the near-zero rates of the pandemic era. These hikes were designed to cool demand and bring inflation down from its 40-year peak of 9.1% in June 2022 to the Fed's 2% target. While inflation has moderated to around 3% by mid-2023, the labor market, which has been a pillar of strength with unemployment near historic lows of 3.5%, is now showing signs of strain. Powell's acknowledgement of heightened employment risks marks a pivotal moment. Historically, the Fed has often prioritized inflation control over labor market health during tightening cycles, as seen in the early 1980s under Paul Volcker, when unemployment soared past 10% to crush double-digit inflation. However, Powell's comments suggest a potential shift in focus, reflecting lessons from past missteps, such as the 2019 repo market crisis, where overly tight policy contributed to liquidity strains. By signaling that employment risks are rising, despite delayed official data due to the government shutdown, Powell is hinting that the Fed may err on the side of caution, potentially cutting rates further to support jobs even if inflation remains sticky. Global and sectoral impacts. The Fed's policy direction doesn't just impact the U.S. economy, it reverberates globally. A dovish pivot toward rate cuts could weaken the U.S. dollar, as markets are already pricing in a 25 basis point cut in October and a near 90% chance of another in December, per the CME FedWatch tool. A softer dollar typically boosts emerging markets by easing debt burdens denominated in USD and spurring commodity prices like oil and gold. However, it could also stoke inflation in import-reliant economies, a concern for central banks in Europe and Asia already grappling with their own post-COVID recovery challenges. Sectorally, rate cuts would likely benefit interest-sensitive areas like technology and real estate, which have been hammered by high borrowing costs. Tech giants, reliant on cheap capital for growth, saw significant pullbacks in 2022 as rates rose, with the Nasdaq Composite shedding over 30% that year. A more accommodative Fed could reignite investor appetite for growth stocks, though persistent inflation, partly driven by tariffs, as Powell noted, might limit gains if input costs rise. Conversely, financials, particularly banks, could face margin compression as lower rates squeeze net interest income, a dynamic seen during the low-rate environment of the 2010s. Data delays and policy uncertainty. One of the more immediate challenges Powell highlighted is the lack of timely government data due to the ongoing shutdown. The delayed September jobs report, which Powell called very important, leaves the Fed reliant on private sector indicators like ADP payroll data and state-level unemployment claims. This is a risky proposition, as private data often lacks the granularity and reliability of official statistics, potentially leading to misjudgments. If the shutdown persists into October, the absence of fresh data could further cloud the Fed's decision-making, increasing the odds of policy errors. Historically, data uncertainty has led to cautious Fed behavior. During the 2013 government shutdown, the Fed delayed tapering its quantitative easing program, citing insufficient economic visibility. Today's situation is arguably more complex, with inflation still above target and labor market signals mixed. Powell's emphasis on a meeting-by-meeting approach underscores this uncertainty, suggesting the Fed is prepared to act swiftly if incoming data, whenever it arrives, points to a sharper labor market slowdown. Balance sheet and liquidity concerns. Powell also touched on the Fed's balance sheet, signaling that the ongoing runoff, where maturing bonds are allowed to roll off without reinvestment, may soon end. This process, initiated in 2022 to reduce the Fed's $9 trillion portfolio, aims to normalize monetary policy after years of quantitative easing. However, Powell noted emerging signs of tightening liquidity, referencing the 2019 repo market turmoil as a cautionary tale. Back then, insufficient bank reserves triggered a spike in short-term borrowing costs, forcing the Fed to intervene with emergency liquidity. Ending the runoff could stabilize money markets, a positive for financial institutions and risk assets. However, Powell clarified that the Fed isn't returning to pre-pandemic balance sheet levels, as public demand for liabilities has evolved. This pragmatic stance reflects a broader lesson from the post-2008 era. Central banks must adapt to structural changes in financial systems, even if it means deviating from historical norms. Investment and policy implications. For investors, Powell's remarks offer both opportunities and risks. A potential rate cut in October could lift equities, particularly in cyclical and growth sectors, but persistent inflation, exacerbated by tariffs, might cap upside. Fixed income markets could see yields on treasuries decline further, with the 10-year yield already down from its 2023 peak of 5% to around 4.2% as of mid-October. However, a stronger-than-expected jobs report, if and when released, could reverse dovish expectations, pushing yields on the dollar higher. On the policy front, the Fed's focus on employment risks suggests a more proactive stance to prevent a labor market downturn from snowballing into a recession. Yet, the lack of data and geopolitical uncertainties, like potential escalations in U.S.-China trade tensions, could constrain aggressive easing. Policymakers must also weigh the long-term implications of maintaining a large balance sheet, as excessive liquidity could fuel asset bubbles, a concern echoed in the housing and tech booms of the past decade. Near-term catalysts to watch. Several catalysts could shape the Fed's next moves and market reactions. First, the release of the Consumer Price Index on October 24th, delayed but still mandated for Social Security adjustments, will provide critical insight into inflation trends. A hotter-than-expected reading could dampen rate cut hopes, while a softer number might cement a 25 basis point cut. Second, any resolution to the government shutdown could unleash a flood of delayed data, potentially altering the Fed's outlook overnight. Finally, geopolitical developments, particularly around trade policies and tariffs, could introduce fresh volatility, as Powell noted their role in driving goods inflation. Conclusion. Jerome Powell's latest comments paint a picture of a Federal Reserve at a crossroads, balancing rising employment risks against lingering inflation pressures amid data uncertainty. For investors, the near-term outlook favors cautious optimism, with potential rate cuts offering support to risk assets, though inflation and data delays pose significant wildcards. Globally, the Fed's actions will continue to influence currency markets and emerging economies, while sector-specific impacts will vary based on interest rate sensitivity. As we approach the October 28 to 29 meeting, staying attuned to incoming data or the lack thereof, and geopolitical shifts will be crucial. In a world of no risk-free paths, as Powell aptly put it, adaptability remains the investor's greatest asset,